Guidance for Standard V examines the CFA Institute standards related to investment analysis, recommendations, and actions within the program. Standard V focuses on the responsibilities investment professionals have when conducting research, forming investment opinions, communicating recommendations, and managing investment decisions. The standard is divided into two components: Standard V, A diligence and reasonable basis, and Standard V, B communication with clients and prospective clients. These standards emphasize the importance of thorough analysis, professional competence, transparency, and accurate communication. Ethical investment recommendations must be supported by appropriate research and presented clearly so that clients can make informed financial decisions based on reliable and understandable information. Standard V, A diligence and reasonable basis requires CFA Institute members and candidates to exercise diligence, independence, and thoroughness when analyzing investments, making recommendations, or taking investment actions. Professionals must have a reasonable and adequate basis supported by appropriate research and investigation before reaching conclusions. Recommendations may rely on quantitative models, external research providers, or internal analysis, but investment professionals remain responsible for evaluating the reliability and suitability of those sources. Blind reliance on unsupported opinions or inadequate analysis violates the standard. This requirement protects investors by ensuring investment advice is grounded in disciplined analytical processes rather than speculation, incomplete information, or unsupported assumptions. The guidance for Standard V, A emphasizes that the depth and scope of required research depend on the complexity and nature of the investment being analyzed. Analysts should consider economic conditions, industry dynamics, financial statements, management quality, valuation assumptions, and relevant risk factors before making recommendations. When using third-party research, members must assess the provider's credibility, methodology, and independence. Quantitative models should also be reviewed periodically to ensure assumptions remain valid under changing market conditions. Maintaining records supporting investment conclusions is essential because documentation demonstrates compliance with professional standards and provides evidence that recommendations were based on reasonable and diligent analytical processes. Standard V, B communication with clients and prospective clients requires investment professionals to disclose investment processes, risks, limitations, assumptions, and significant factors underlying recommendations and portfolio decisions. Communications must be fair, accurate, complete, and presented in a manner clients can reasonably understand. Professionals should distinguish clearly between factual information, assumptions, opinions, and forecasts. They must also explain the general principles of investment strategies used and promptly disclose any material changes that could affect recommendations or portfolio management approaches. Effective communication is essential because clients rely heavily on investment professionals for guidance regarding financial risks, expected returns, and portfolio strategies. The guidance for Standard V/B further stresses the importance of transparency regarding performance presentation and risk disclosure. Members and candidates should avoid guaranteeing returns or implying certainty about future investment outcomes. Investment communications should include appropriate disclosure regarding volatility, liquidity risks, leverage, and other material considerations that may affect portfolio performance. Professionals must also communicate changes in investment philosophy, analytical methods, or portfolio strategy promptly when such changes materially affect client expectations or decision-making. Clear communication strengthens trust, improves client understanding, and reduces the likelihood of misunderstandings or unrealistic expectations regarding investment performance and portfolio risks over time. Overall, topic demonstrates that Standard V plays a crucial role in maintaining professionalism, analytical integrity, and transparency within the investment profession. Diligence and reasonable basis requirements ensure that investment recommendations are supported by disciplined research and thoughtful analysis rather than speculation or unsupported assumptions. Communication standards reinforce the importance of accurate, complete, and understandable disclosure regarding investment strategies, risks, and recommendations. Together, these standards protect investors, improve decision-making quality, and strengthen trust between clients and investment professionals. For CFA candidates, mastering Standard V guidance is essential because rigorous analysis and transparent communication are fundamental responsibilities in portfolio management, investment research, and financial advisory practice.